Traders, welcome back to another episode of Market in the Morning. And am I excited, man? We have the one and only Jeev with us, one of the best fundamentals and best gold traders I know. Extremely excited to bring him on. We're going to set you guys up with the best trade setups possible today and what's fundamentally moving markets, because technicals are great. They could possibly help us get entries, but if we're taking a technical trade against fundamentals, we're most likely going to lose. So let's keep an eye on market. Hit that like and subscribe button, and let's get started. All right, good morning, Jeev, good morning. How are you? Welcome.
Thank you, man. Thank you, Kevin. Thanks for having me, man. I always appreciate that high energy intro, man. Really
Absolutely. Got to bring that market energy, bro.
So we do have jobless claims coming up. You know what I mean? Perfect
Yep.
thing for us to look out for as retail traders with a little bit of data that can impact US dollar pairs and gold. So you want to check out the economic calendar here? Check out the market playbook.
Let's dive right into it.
Okay, so perfect. So we have initial jobless claims coming up in about 10 minutes. I still think that this data should be getting presented. You know what I mean? I know the US government shutdown has still been active, but the Bureau of Labor Statistics has still been releasing a couple of reports here and there. They sent a headline, which we got in the market news feed, that JOLTS job openings and jobs data would still be released today. Now, one thing we noticed is that obviously, as interest rates are up, financial conditions are tighter. This can weigh negatively on labor market data and other economic activity, right? So we may see initial jobless claims edge a little bit higher this report. You can see the previous was around 209 here, and we have a forecast, both a bank institutional forecast and a regular forecast of 212. Now, what's great about the market economic calendar that a lot of economic calendars do not do is that we have a minimum and maximum expectation. A lot of retail traders are going to say, gee, what's the whole point of that? Now, this is very important for you guys because this is your indication of market conditions and potential more volume and volatility that you may be able to trade. Besides data just coming out above and below forecast, if you exceed the minimum or maximum expectations, for example, let's just say initial jobless claims forecast is 212, but we come out at 225K, more people in the US filing for jobless claims, that is above the maximum expected expectations here. This is your indication that this specific report outcome can bring way more volume and volatility. And this is something that's unique to very few economic calendars out there, especially at the price point and especially at the value point that market shares it at. So, you know, us, we are slaves to volatility, right? The more volatility and volume, the better for us. It gives us more excitement, gives us more information to play with. I would love to see that if initial jobless claims is starting to edge a little bit higher, we could potentially come out above the maximum point here, which can still lead to a little bit of dollar bears, gold bulls as well. Now, the beautiful thing is just by clicking the brain button here, you get a playbook. So never mind the minimum and maximum expectations. What other economic calendar out there is giving retail traders an exact playbook to take advantage of, right? So this is what I was talking about. You can see that if jobless claims comes out above the maximum point, it's going to be very bearish for the US dollar, not just slightly bearish, right? So this is what I mean where we could take advantage of potential more volume and volatility. Now, the one area where traders make a mistake is that they think as soon as data gets released, that first second after data gets released, that they could just enter a trade. No, pricing is always still very important. You still have to have that little bit of patience for any liquidity grabs, spread spikes, things of that nature. Allow the markets to retest more optimal prices and then potentially look to play some of those trades. But what do you think about jobless claims coming up around the corner here? What's your 2 cents?
Yeah, no, so I couldn't have said it better myself with initial jobless claims. It comes out every Thursday. So it's not like one of those crazy events like FOMC or non-farm payroll that will always give us a crazy move. But using that forecast, that range, we're able to see, okay, if we do hit a strong spike, then we can expect a crazy move. This is still a strong enough catalyst with the right report.
With the right outcome, yeah,
Right.
especially if we use those market indicators, if it exceeds the minimum or maximum. And that's a
100%.
great point you brought up, that initial jobless claims is reported weekly.
Yep.
It's not going to be as hard hitting as when you have your NFP, your unemployment rate. But that's a great point that leads us into a jobs report that may hold a little bit more weight today, which
Yep.
Jolt's jobs openings at 10 a.m. What do you think about Jolt job openings?
Oh, we're gonna see. We're gonna see. I think it shows consistency to the downside if we're looking at the market historical data chart down there.
We have been slowly trending down here, which is a great feature to see the data plotted alongside the actual values and forecast here. And
Yep.
again, even if both of us are absolutely clueless on what to expect for this data, we can still have such a reliable framework created by utilizing this playbook, right? We know that this data's outcome can potentially give us more signals on rate cut expectations or delay rate cut expectations. We know that it is a wage growth indicator. We can even get a bit of a signal of the average movement on the US dollar individually, right? What I would love to see is some one-sided economic data through the majority of the New York session today. Jobless claims edging a little higher. Hopefully we get some fireworks and it's above the maximum expectations so we can play this part of the playbook here. But the beautiful thing is, even if your initial prediction may be wrong, you know exactly how to adapt accordingly. The playbook makes it so easy. It's even color coded, right? But I would love to see one-sided economic data. What do I mean by that? Well, today we just have employment sector reporting. We got the initial jobless claims coming out in 3 minutes, and then we got Jolt's job openings coming out an hour and a half after that. The worst thing for us as retail traders is when you have data reports butting heads. You have a tug of war between data. You may have had, after the commodities exchange open, some very pessimistic bad data. But then after the New York Stock Exchange open, you get really good data. Now your price action is just a mess. Now you're just whipsawing on gold up and down and ripping your hair out. So today, if we can see Jolt's job openings, like you said, continue that little bit of a bearish trend and come out weaker, initial jobless claims a little bit higher, it still shows us that the labor market in the US is weakening. It can still give us some signals of Fed rate cut bets, which we could still play like for a potential shift on gold still being bullish. Now, when we're looking at the market dashboard, gold on the intraday is just slightly bearish, but we've already hit that target level. More times than not, when that target level is hit, you get some price reactions from there. So as this target's already been achieved, we may see some of those intraday slightly bearish sellers with just medium confidence in this take profit. If they have the fundamental catalyst of weaker jobs data to take profit, we're going to bounce from here all the way back to this pullback area, which is still potential momentum for us as scalpers and intraday traders to take advantage of. And we could obviously see that weaker jobs data would be a reason to potentially come back up here as well, right?
Yep.
What are you looking out for on gold? Do you want to share your screen, or do you want to break down
Yeah. Let me sure.
or should we just wait the 1 minute for the jobless claims release first and then?
Oh, let's wait. Good call. We'll wait for that.
Yeah.
We'll see how markets react. What you were pointing out before, though, how we're sort of getting those mixed signals when it comes to reports on
Jobless claims above the maximum expectations are very hot. So you can see here in the market calendar, you get a nice little flame emoji if it's outside the expected range, which is a signal that higher volatility may occur. So that capital hungry prediction alongside the market expectations, a huge surge in jobless claims. Yo, give me your 2 cents on that.
That's awesome. That's awesome. Yeah, I mean, listen, the fundamentals, I think I mentioned before how if you have the right technicals, whatever, but if you're going against the fundamentals, you're sort of screwing yourself. So, like you said, the capital hungry breakdown and then the market fundamentals coming back. That's awesome. My 2 cents on the initial jobless claims coming in higher, sort of expecting that. We're still in a strong AI bubble where it's taking jobs, taking jobs, taking jobs. We've yet to reverse that and start making new jobs around AI.
That's
So,
true.
you know, manufacturing, we were mentioning just before how data was back and forth. Believe we had manufacturing was really strong last week, and then non-manufacturing PMI came in yesterday extremely weak. So economics are very 50-50 right now.
Yeah.
Geopolitics are also a lot of tension going on.
So this is good though. This is good for us
Yeah.
for some at least expected volatility today. Now, if we can get what I would like to call that double whammy, if obviously we're not going to be running this live stream that long, but just for our viewers in the chat right now, first of all, give some W's in the chat for that prediction that jobless claim was going to be out of the water here, higher than the maximum expectations. That's on point. We
That,
came out higher than the forecast, higher than the maximum expectation, which once the noise and dust settles can be very bearish for the US dollar. And of course, in turn, still increase gold's safe haven appeal, right? Now, the double whammy is if we can also get an hour and a half from now, Jolt's job openings are lower. It's either the same as prior or lower than forecast. Then we're going to have that double whammy, that double play for US dollar being more bearish here, which can still keep gold more bullish. So like I was talking about when we were looking at our market levels, for the sellers in the short-term intraday bias, we already hit their bearish target, which was this support level in demand zone. Through the New York Stock Exchange open, the new 4-hour candle, if we continue to hold above this intraday price, even if we don't see a huge surge in volume and volatility, you can easily see some scalps, intraday momentum plays, taking it level to 49.20, back up to 5,000, and even back up into 5,100s, right? Like Kevin was laying out there. We still have geopolitical tensions lingering. Iran nuclear talks have sort of been losing ground, which can still keep gold safe haven appeal strong. Dollar potentially still seeing a lot of bearish pressure with rate cut bets being priced in. We're getting a little bit of a technical intraday double bottom at a key demand zone here on gold as well.
yeah.
So especially through the price setups going into deeper New York session hours, if we don't have Trump coming in on the reactive headlines in the market terminal announcing world peace, we don't have anything to take away the safe haven appeal. Gold could easily be bouncing to those pullback areas in the 49.50s and higher.
Yeah, that looks solid. I'm with you on that. I think this drop on gold, drop on silver lately, I think it was just an increase in popularity that was driving price lower, right? It was sort of a sell the news situation. Everybody and their mom was getting into silver when silver was breaking above 100, 120, and now here we are, silver back below 80. All those people crushed, never going to invest again, just for it to climb back higher and then feel a little stupid. So
That's a great point. Whenever you have too much of that public mania,
yep.
it's our signal as traders, like, all right, we got to get out of this.
Yep, here's the high.
Yeah, here's the high. That was the peak high. The institutions are going to use all that public attention as exit liquidity.
Yep.
It's something you see quite frequently on the crypto markets, but it looked like gold and silver turned into a crypto market for a short term, right?
Bro.
With that huge surge in volatility.
Seriously. Silver on the daily, man, was nuts. We were just at $20 just 2 years ago.
Yeah, huge volatility. Even gold, just that parabolic move
Yeah.
into 5,600 in one Asian session, and then it flushed out was just insane, right?
Nuts. Absolutely.
But that's the thing. Volatility for us as day traders, it's a double-edged sword.
Yeah.
If you have the experience and you adjust your lot sizing, your take profit and stop loss, and you're still very calm and collected with your areas of interest to enter and potentially exit, you could still take advantage of huge moves. But for the people that are still trying to trade gold with a 10 pip stop loss, like it's 2021, you're done for, right? You're
Yeah,
done, buddy. You're cooked.
instant stop.
I just
But
want
yeah,
to
no,
quickly check out the news terminal here, see if we're just getting any hard hitting headlines, because we did have a Bank of England speaker here, a bit of a review of the U.S. economic data, which the labor market data is a little bit weaker. We had the EC. Do you trade euro at all?
no futures, just ESNQ and gold.
You're the SPX master. You want to share your screen and go through SPX expectations?
Let's run it.
Let's
Let's
go,
do
bro.
it. You ever trade I know it's not SPX for futures for forex, but you ever trade the S&P?
Yeah, bro, I love SPX. It's been a little bit tricky the last couple of weeks, just as it keeps lingering at all-time highs. Like you see those same profit-taking moves at all-time highs, and then some
Yep.
nice intraday bounces. But let me get some expertise from you on this.
I got you, man. So I want us to first touch up on what we were talking about earlier with the data, because fundamentals are what moves markets, and what's great with markets annotations is now we can really see clearly how it's moving markets. So ISM manufacturing surged to a 3.5-year high, drove a rally. This is our last little run up that we had. This was this past Monday. Anybody who is trading this SPX or even NASDAQ knows that Tuesday we had just as strong of a sell-off. We sold off that whole move, over 700 points on the NASDAQ. ES also moved about 100 points. This came from, where are we? ES plunges on heavy selling, so selling volume. We click it here on market as well.
Which was pretty much like that was the all-time highs price, right? Some profit taking.
Yeah, very near it. Let me see. Pull it up on the charts. So like even NASDAQ here, down 5% from its recent high. Very strong moves. These are pullback levels, but once we hit that 10%, we're sort of hitting that bear market. So
Yeah.
ES has been really having trouble getting to a new all-time high and staying there. You see right over here. Let's see. All-time high, we failed. All-time high, we failed. We're really struggling up in the 7,000 key cycle level up here. And really, with very few fundamentals backing a bullish move, I can really only see us range bound. Let's check. I do want to see market-wise. So ADP employment plus 22,000 prior, missed the 41,000, which was prior. So again, here's some weakness in the job sector. We had the
just saw
initial
that.
jobless claim,
Yeah.
right? Like tons of weakness. So it's definitely a tough point. ISM non-manufacturing employment also missed. Cook latest core PCE reading way above target. AI spending jitters. So something that's a bit separate from the ES and some of this other stuff, but still fundamentals, is the CapEx. I'll see if it still mentions it right here. So AI CapEx spending, it's really how much the company's spending per capita for AI. Now, Meta came in at like 134 million, like way
Wow.
above expected. Yeah. So what's sort of lingering in the tech sector, which really affects the S&P 500 as well, is, hey, listen, are these companies overspending on AI right now? Where is that return? If they're spending this much, are they starting to get that
Where's the
back yet?
profits from it?
Exactly.
Yeah.
And more recently, let's see, AMD Q1 revenue forecast disappoints despite Q4 beat. So this is important too as an investor, as a day trader. When we hear about earnings, a lot of times we think, okay, earnings. Did it beat earnings per share? Did it beat revenue? And we never ask about what about the earnings call. But the earnings call is one of the most important parts, because that's when we listen to the CEOs, the large people of that company, give us a roadmap of what their company's going ahead for the next quarter. And if on that call they sound a little skeptical, like, okay, well, what would we say? AMD Q revenue forecast. If they're saying our revenue is going to stay a little stable, but we might see a small hit. If you're a large long-term investor or a big institution and you hear a company that you have $100 million invested in goes, our revenue might not be too stable going forward for the next quarter, you're gonna want
Red
to get out of
flag.
that. Yeah, you're gonna be like, get me the hell out of here.
Yeah.
So all of these different technical and tech sector issues are really lingering on the Nasdaq, which ends up lingering on the S&P and 500 as well, because right now the Nvidia counts for 8% of the entire S&P.
Which is insane weighting.
Insane, bro. One company? That's nuts.
Yeah. So we have the pressure of prices being lingering around all-time highs. We have the pressure where a lot of that, even that rate cut hype has faded with
Yep.
Trump picking the new Fed head in that event priced in. And then these are great points about the AI capex spending. All
Yeah.
these companies that were hyping AI, investing so much in AI, all these investors are saying, okay, we followed your hype, but where's the profits now? Where's the
Right.
earnings from this? Where's the growth from this? And these guys don't have any answers for it. So it's a
Yep.
great fundamental reason why we've seen technical consolidations or more profit taking from record highs, and we've seen a suppression in price of not of. And we're not in that time where just every day we're printing a new high in stocks. Remember
No.
that just like a year ago?
Yeah.
Every
It,
day a new all-time high being printed. The AI hype was in its prime. Now
yep.
it's sort of like the noise and dust has settled, and these guys are saying, "All right, we can't be dealing with this anymore."
Nah. Like look at almost every other bullet of information. What's supporting the bearish bias on NQ is mentioning the capex. Alphabet forecast 185 billion 2026 AI capex. Microsoft guidance 22 to 23% on AI capex. So here comes sort of that bubble, right? We always talk about is AI in a bubble. I don't think AI itself is. I think we're going to continue to evolve in AI. It's going to find its way into everything. But can it be hitting that profit bubble where companies are sort of, everybody has access to AI.
It's
Anybody can
similar
make
to the dot-com era, right?
Yeah,
Where it's not like the technology of the internet is a bubble, but all these companies that were coming in hyping internet and having these internet businesses and huge profits, they were just too greedy in that early stage. Is something we're seeing very similar with the technology of AI. I
yep,
agree with you. The technology of AI is not a bubble,
nope,
but all these companies fueling AI hype
nope,
that are over greedily saying these huge expectations, they're causing some trouble here.
100%, 100%.
So
Awesome.
are you going to be looking for any positioning on NQ or ES like post New York Stock Exchange open today?
Yeah, I'm probably going to be looking for some shorts on the NASDAQ, possibly the ES as well. Would probably go for the NASDAQ first because obviously it is more tech sector. So
Yeah.
it's going to see if we have bearish momentum. It's definitely going to see that a lot stronger than ES. ES, I like to tell the traders I trade with that when we're looking at the ES, we want to make sure NASDAQ's trending with it, but we also want to keep a bit of a close eye on the Dow. I say weigh it
Okay.
as sort of like a 70-30, where 70% holding is a trend of NQ and ES are going to be very confluent with each other, but the Dow sort of has that pull. If the Dow is going in the opposite direction, we're not going to get as easy as a trend on the ES as we're
Yeah.
getting on NASDAQ.
And it's great to use some of those intermarket correlations. Like you keep an eye on how these large stock market indexes are moving as a whole.
Yep.
What is the market mood and sentiment you're seeing on your macro US data on top of the AI capex spending issues? There's still a lot of trouble with the employment sector, which makes it even more difficult for these companies to continue pushing more earnings and revenue hype, and you have a bit of a recipe for disaster for buyers at all-time highs, but you have a short seller's paradise.
That's a great way to put it. That's a great way to put it. Right now, guys, we're risk off in the ES and NQ at the moment until we get some type of strong catalyst, strong economic data. But right now, our economic data is coming in weak. I'd
We still
like
have
to,
some nice lower lows being formed there too. It looks very
yeah,
clean.
real clean price action to the downside. We have the support right here, held as support right here. I would want to see it work as resistance. It already has. So I would like to see this new resistance point we have right here, which already worked in the pre-market, work again during the New York session. Because again, looking at this momentum, this is not a chart that says, oh yeah, we're just going to reverse now.
Yeah.
This is still giving us some good bearish momentum. I would like to see maybe the 9 o'clock or on the 8 o'clock candle So 8 o'clock close somewhere over here, 9 o'clock spike higher, create an upper wick. We get short on that upper wick.
A
We're
little
able to
dead
hold it.
cat bounce to trap buyers in there, get buyers thinking like, oh, it's a reversal coming into play, and then they get
Exactly.
used as exit liquidity.
Exactly. It's what I always look for on my setups is where are those lower time frame people getting trapped?
Great idea. Smart.
Yep. Awesome. I'm gonna send it back to you. We got some people asking about gold again.
Yeah, perfect. So for me, when I'm looking at gold here, right? Obviously, when we're looking at gold, something very beautiful that happened. People say the markets are random. I think the markets are extremely surgical, right? So you can see here that we have this beautiful bullish higher time frame structure. Conveniently, whether you want to say randomly, this wick from the flush out went to pinpoint retest these previous highs to the left here, right? Now, obviously, we could still do some higher time frame double bottoms in this area. The probability of that is always something you need to look out for. But when we're looking at some of the intraday structure, we're still holding above some of these key demand zones to the left, which is giving us a little bit of fundamental support early this New York session as jobless claims data was horrible, right? So that makes me want to zoom in to some of the intraday time frames here, where I'm still looking at these zones of interest. Now, for me, as a day trader, 80% of the time, I want to be riding the fundamental supported trend with technical evidence behind it. 20% of the time, I'm skeptical of retracements, flush outs, buyer profit taking, and so forth, in the example of gold in a bullish trend. So some of these yellow zones up top are more of the danger zones of where I'm going to be expecting some profit taking or retracements. But what I'm mainly going to be looking to target with initial jobless claims spiking higher than maximum expectations, dollar still being in lower low and lower high formation, some of those Iran nuclear talks starting to go south there, right? If we're going through the New York Stock Exchange open, if we see a liquidity grab and fake out to the downside here while still snapping above this demand zone, then we still have some pretty decent ranges to play. Now, the tricky and troublesome part is when you're looking for a singular bias to play, if you break your first area of interest, people can get very attached to that. And every single little 10 pip, 20 pip drop, they keep trying to buy. Avoid that. Remember right now that if we're buying gold, from my perspective of what I'm sharing to you guys, we got three main buy zones of interest. We're looking at around 4780 to 4800 flat. After that, the next major buy zone for me isn't until like 4650s. And then after that is like 4500s, right? So that means in between these zones, you either sit patient and pretty and just sit on top of your hands in the office here, or you take advantage of a short-term sell scalp. For me, I don't like to jump back and forth between bias too much. So I'm just going to be waiting for these areas of interest to still continue our market swing trading in higher time frame bias, which has still been showing us central bank purchasing has been strong, geopolitical tensions are lingering, and of course we had the bad data reports. Now, a great follow-up after the New York Stock Exchange open is that if we get that double whammy prediction, both our predictions of Jolt's job opening also comes out lower, then we're going to have very weak jobs data, increasing Fed rate cut bets for potential price action like this of having some higher lows created, buyers jumping in from lower discount demand zones, and still maintaining bullish structure to potentially be squeezing into these prices back into the 5,000s and 5,100s. I think a lot of the selling on gold has been completed. The market whales flushed out all of those late impatient traders. We've already hit some more discount prices, but this is the golden nugget for you guys that I usually don't share so much publicly. You have to adjust your expectations of volume and volatility accordingly. Let me give you guys an example during this parabolic rally here. So you can see here in a very short period of time, within 2 weeks, gold surged from about 4,000 all the way to 4,400. And then when we had this flush out play and correction, gold still maintained its bullish market structure, but it took almost 5 times longer to retest those same highs again. You can see here the volume and volatility was night and day different versus the parabolic phase here. You had more lower lows and lower highs forming. You had more periods of consolidation. But slowly but surely, because the macro fundamentals never shifted, you still came back to those same highs. I think we're going to see a very similar case on gold here over the next few months. We had abnormal volatility with parabolic upside here, which was just excessive to start out this new year. For a lot of traders, it was even very difficult to get in this or know when to get out of positions as well, right? You had this abnormal parabolic upside volatility. Then we had an equal flush out here. That bullish structure got retested and was not broken. I don't think we're going to be going up just as fast. I think that it's going to take us months to potentially get back up into those 5,600 prices. We're going to have more controlled, normal market conditions, more higher highs and higher lows being created, which is great for us as day traders because those market waves give us more opportunities to play back into the upside. So through this period of time, if we're looking at our market dashboard and the swing trading time frame stays bullish, we still have healthy central bank purchasing demand. Structure remains bullish as well. 80% of the time, my day trading positioning is going to be waiting for these higher lows, waiting for these continuation plays to slowly keep creeping back up into these high targets in the 5,600s. So right now, when I'm looking at gold's pricing setup, that's what I see setting up here. I don't see a major sell-off wave. I see the potential of a bullish channel being created if we still have weaker U.S. jobs data, as we may react to some of these supply zones to the left here, but just see short-term reactions as we create a wave formation back to the upside, where I'm going to be more dominantly playing some of the bullish moves back to the upside, right? So that's just my little 2 cents. Institutional intel there, breaking it down using our market data, with me still looking at some of these dominating factors on the swing trading time frame and looking at some of these target areas that we could slowly but surely still continue to depend on as day traders as well. So on a day trading time frame, we're still holding these zones. I'm still at least expecting to retest these same highs, not really see another price wave until we get up into here, and using these short-term resistances after as supports to still be primarily buy dominant here on gold.
Yep.
But hopefully the chat gets enough value from a little breakdown like that.
Guys, awesome. Great stuff, man. Definitely hit that like and subscribe button, guys. We have Jevan for Market in the Morning on Thursdays. I hosted Tuesdays and Thursdays, 8:20 to 9 o'clock. So we go over any economic data that comes out that day. We prepare. And if there is no economic data, we still go over the fundamentals because markets are always moving.
100%. 100%.
Did you see Bitcoin dipped below 70,000 for the first time?
Just hit 69K. Hit the. I think these market whales are going to jump in at the meme price of 69,420.
Yeah. Oh yeah, that would be funny, bro.
You know what I mean?
That'd be great.
I think 69,420 is there. I have a key level at 69,420 just for the memes. You know what I mean? And you can see this wick bounce here and exactly where we're reacting to right here.
Yep.
We're calling it live here first, Kevin. If the bullish rally back to 120 starts from here, you know these guys are bros just like us.
We're pretty close right now. Though we're at 69,550.
Yeah, so 69,420 is gonna be that meme price for the boys.
That's great. Or you know what? Nah, bro, we gotta update it. It's gonna reverse around 67,000.
The new 6-7, eh? You're with the times. I'm unk now. I'm
Bro,
old, bro. I'm unk now.
somebody OG'd me the other day in the comment. I was like, get out of here.
What happened? What happened?
They called me OG, bro. I'm like,
Oh,
nah,
they call.
it's Unk.
You know what? You know what? I don't. OG sounds cool.
Yeah, I feel like that's
Unk's
a
a little
step.
bit. Oh, you think OG is? Oh, is
Isn't
that the
that a step
timeline?
above Unk?
Fuck, I don't know. I thought OG was just original gangster. OG, you know what I mean?
Well, that's what I thought, but I know that they call the old heads OGs.
Oh shit! So they called you above Unk, is how you took it.
You know what? It's
No,
because of all the knowledge I get from market. They must think I'm so old with all the wiseness, guys.
yeah, they automatically assume we're sitting on the JP Morgan's board table there, making these directions with market.
Yep, that's awesome. That is great. Guys, again, like and subscribe. Fantastic episode. Jeev, thanks for being on today.
Yeah, man. Thank you for having me, man. It's a great to be with you here. Time flies whenever we're breaking down markets together, going through and showing the value of the market dashboard and how much information these guys can take advantage of to make more money using fundamentals. That's the main thing we want to push with the dashboard is that even if you're a technical trader, you can learn to follow fundamentals to increase your profits or decrease the amount of losses by leveraging this information that most retail traders are ignorant to, right?
Yep, exactly. Guys, again, technicals are nothing without fundamentals. You could take, like we were going over before, if gold breaks this level, don't take 10 more losses underneath it. If it's breaking that level, there's probably a good fundamental reason why we're still pulling back.
100%, 100%.
Awesome. Guys, hit that like and subscribe. Join us Tuesdays and Thursdays. Chief, thanks so much for being here. That's the end of the show.
Oh, we're already wrapped.
Oh, shoot.
Thank you, man. No, thank you, man. Thanks for having me, man. Appreciate you.
Absolutely, bro. Take care.